What a morning. Good morning, good morning. Just about out of breath. Your equity market just about positive. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Ferro.
Live from New York, we begin with the big issue, central bank intervention.
This is an extraordinary situation.
Clearly, the Bank of England has got a problem.
I'm pretty critical with about the actions that we've just seen here.
I'm not sure that they actually need to respond to anything here.
The Bank of England is effectively adding more liquidity into the system.
In Asia, we've had India and the Philippines intervening, Bank of Japan intervening.
But I'm not sure that the BOE is doing the right thing.
No doubt we are seeing dysfunction in the markets overseas.
This essentially EM-type price action in the United Kingdom.
The price goes up, the price goes down, and the price is always responding to news.
You're talking about global markets moving 20, 30, 50 basis points off of one data point or one policy announcement.
I understand it's only temporary.
But if anything, this places more pressure on them at the front end of the curve.
Just an extraordinary situation.
We're not quite sure where they're going.
The Bank of England stepping into the gilt market, writing in a statement the following. The bank will carry out temporary purchases of long-dated UK government bonds to restore orderly market conditions on whatever scale is necessary to effect this outcome. Out of London, a good friend of this programme, good friend of mine, Guy Johnson, joins us right now. Guy, what is going on this morning?
The Bank of England has had to respond, I think, to a number of phone calls that have been coming through from the pension industry, from the defined benefits pension industry, which is basically an industry that is now facing chaos, margin calls, and there was a serious concern that were that to escalate, you could see a significant crash in gilt prices. They've stepped in to avert that. This is an FPC decision. This is an MPC decision. So this is a financial stability decision, not a monetary policy decision that is being made here. It is basically designed to attempt at least to stabilise that key and critical portion of the market. What it hasn't done, John, is remove the need, according to many in the market, for a significant rate rise from the Monetary Policy Committee, and it hasn't had a massive impact in terms of the swaps market, where mortgages are priced from, which is what a lot of people are panicking about in the UK. Now, I'm looking at the two-year swaps, the interest rate swap over the last 3 days, actually. It is beginning to roll over a little bit now, but we are still at very elevated levels.
Guy, next scheduled meeting, November 3rd. I chose my words carefully there. Scheduled. Can they wait that long?
It depends on a number of things, John. A number of things could stabilise this situation. You could see, obviously, action from the fiscal side. The government could change tack, listen to the IMF. I don't know. But you could see something coming from the government which would help to stabilise the situation. In the absence of that, then increasingly the view is that they probably can't wait that long, that we need some sort of economic stabilisation here that needs to come from the MPC, and that probably means, I was listening to Danny Blanchflower a few minutes ago, that probably needs a significant rate rise. That is certainly what the market is still signalling at the moment. You look at what is happening with sterling, you look at what is happening with the rates market more broadly. That is what is being signalled right now. What they've done today is put a sticking plaster over one bit of the market that was facing a crisis.
Guy, there's plenty of questions about whether it was facing a crisis. They say they're doing this to restore market functioning. Was there anything dysfunctional about what we've seen in the gilt market? We've got yields down today by 100 basis points at the long end in the UK gilt market. What was dysfunctional about the last couple of days, Guy?
So I think if you take a step back, you look at the scale of the moves. In isolation, as long as the market is functioning, the scale of the moves are almost irrelevant. I know that's not quite true, but the market was in some ways functioning, trying to set a price, a clearing price that international investors in particular could accept. I think the issue here was that there was a particular kernel of the market that was dysfunctional, and that was within the rules, heavily rules-based system that exists around the defined benefits pension industry. And I think that's where the real dysfunction was, and that is why the bank has stepped in to do what it has done today. It has not solved the price dysfunction. It has solved the problem that existed at the long end. Yesterday, as I left the office, the 30-year was just rocketing higher and higher. That is where the pension industry lives. That needed to be fixed. That was dysfunctional. Now they've got to address the rest of it. This is a job quarter done, half done. It is by no means fully done.
Guy Johnson, out of London. Guy, thank you. The long end of the gilt curve, we're down 100 basis points on a 30-year to 397. On a 50-year, we're down 105 basis points to 360. Now, what you witnessed through this morning was a surge in the gilt bond market, yields aggressively lower. Sterling still weaker on the day, though it's off the lows. We're down about 0.7% at 106.60. Joining us now to discuss this tall backers Michael Purvis, Mona Mahajan of Edward Jones with us as well. Mona, we're seeing central bank intervention a whole lot more from the BOJ in the past couple of weeks, from the Bank of England this morning. Is something breaking here, do you think, Mona, that this Fed needs to pay more attention to?
Yeah, thanks, Sean. I think this was always the concern of markets and investors when the Fed was moving so aggressively higher, 75 basis point rate hikes, unprecedented, moving towards a 4.5% terminal rate. Haven't seen those types of levels really since 2008, 2009. And so what we're watching for are these exogenous shocks. Now, the good news, or the silver lining perhaps, is thus far we are seeing it in currency markets. We're seeing it in international bond markets, perhaps to some extent in the emerging market space as well, which is feeling a lot of this pain that Jerome Powell has been alluding to. Now, here in the U.S., keep in mind, our credit markets have been functioning in a relatively orderly fashion. We have seen credit spreads widen, but nothing close to what we would call panic or distress levels. We have a banking system and a financial system now that is much more sound than what we saw back in 2008, the great financial crisis. And of course, we are an economy that's somewhat more resilient to foreign oil markets, a labor market that's still pretty sound. So the fundamentals are intact, but some of these cracks we're seeing that are emerging internationally and globally, the risk is really, can they become domestic problems as well?
Michael Purvis, I would just want to get Michael Purvis's view on this as well, Mona. Michael, what's your view on this?
Look, we're looking at a Fed that's gone through one of the most massive transformations just in the last 12 months. And, last year, dollar strength was a very quiet sort of backstory, if you will. And even through a lot of the first half of this year, now it's sort of really emerging as sort of a key sort of macro problem. And of course, there's always two sides to the FX story, what's happening in the US and what's happening over in the UK or Europe and so forth. But I think this is going to be a very enduring thing that's underscore risk appetite or be a challenge for risk appetite, regardless of what kind of economic and earnings data we get here. If you're looking at the yuan, it's just now decided to break through to fresh lows against the dollar. That's another sort of facet of this thing. And so the Fed has of course gone aggressively after inflation, but the second order impacts there, of course, enhanced by what's going on in policy in the UK, your country there. But it's going to underscore very high FX volatility. And that is ultimately not constructive to get a sustained bid in risk assets.
Mona, I can't keep up with central bank policy. First it was QE, QT, and we're calling this morning quantitative confusion. What on earth is going on with policy abroad? 1 minute they're going to be selling gilts and now they're buying it until the middle of October.
Yeah, this is really a classic sign of perhaps there is some dysfunction in credit markets that the central banks there had access to that maybe the rest of us hadn't seen. And they got to a level of concern where they did have to step in and create a little bit more order in those markets. Now, keep in mind, markets here reacted somewhat positively because ultimately the hope of investors is that at some point our Federal Reserve also pauses, perhaps also steps in with more easing. What they're doing in the Bank of England is essentially providing more liquidity, essentially creating a bid for these assets as well. But I think the differential, of course, is that as we noted earlier, thus far, we are not seeing any disorder in the U.S. credit markets. And thus far, no reason for the Federal Reserve to make any sort of similar pivots or moves. That being said, I think the Fed is watching very closely what's happening abroad, what's happening domestically in terms of more and more calls for slowdowns, economic downturn, recessionary conditions. I don't think they want by any means to push the U.S. into some unnecessary, deeper, prolonged recession either. So it is on their radar, but not ready to step in yet.
Do you think that this equity market could well be unbuyable until this Fed witnesses the whites of the eyes of recession?
I think it may be range bound until we see a pause in this Federal Reserve rate hiking cycle. Now, keep in mind that implies that yields have to kind of stabilize as well. In the U.S., we've been seeing a 10-year close to 4%. We need to see yields stabilize, perhaps even start to move lower before we can get a sustainable rally. And then, of course, the big story this year was the inflationary pressures. Now, the good news there, we're starting to see commodities headline inflation perhaps roll over, but we all know the story on core inflation. It is stickier, although the underlying housing market and perhaps even the labor market is softening. So we could make a more credible case for inflation having peaked and starting to roll over. What we're waiting for is a yield story to catch up as well.
And Michael Purvis, we've been waiting for this Federal Reserve to pivot, to pause, to do something, whatever, through much of this summer. It hasn't happened. I've been questioning whether a Fed pause would even be bullish. Michael, would a Fed pause be bullish if they're just doing nothing in a recession when we've been so used to them cutting when they see pain?
Look, if they get another 75 and another 50 done, and then pause there and kind of articulate that we're going to just probably stay at these levels for some time, right? Then probably that's going to bring down some of the extreme rate volatility that we've seen there. If they can articulate that this is sort of our new strategy, is not to just hike, and then cut, but kind of like bring it up to a healthy level, and then sit back and watch, hopefully, inflation continue to contract, then I think that would be a condition where equities could get bid on a sustained basis. But I think that's we don't really know what it's going to do right now. You saw the setup coming into from the CPI print into the FOMC last week. It was a very clear setup that, with the 10-year about to break in through key technical levels, that they didn't care about breaking those things. I do think that you're probably going to start seeing, if we get a soft inflation print, I think it's October 13th when the September CPI comes out. If that print is soft, you could really start seeing a much more constructive environment there. I just don't know how sustained that condition is going to be, because a soft CPI it could be followed by yet another hot CPI, and the Fed doesn't know how that's going to play out either. So I think there's going to be a fair amount of uncertainty one way or the other. That doesn't mean we can't have a strong rally, a tactical rally into year end either.
Michael Purvis, Mona Mahajan, to both of you, you're going to stick with us. Equities right now just about negative on the S&P, down almost 1/10%. Coming up, the administration, the White House, sticking with its optimistic outlook for the economy.
There's no certainty in any way, or no way inevitable that we're going into a downturn.
That conversation up next.
Do you see any possibility of a global accord to kind of adjust currency values the way there was with the Plaza Accord, or is that just not something you're focused on?
I don't anticipate that's where we're headed.
White House National Economic Council Director Brian Deese does not expect another Plaza Accord. This as the dollar eyes a seventh day of gains, touching another record high. The dollar index at 114. Secretary Yellen saying there's no cause for concern, telling reporters we haven't seen liquidity problems develop in markets. We're not seeing the kind of deleveraging that could signify some financial stability risks. Markets are functioning well. Bloomberg's Anne-Marie joined us now from D.C. AMH, those two individuals I just mentioned, Brian Deese and Secretary Yellen, will they be in this administration in a few months' time?
Well, I think, one, the message in terms of what's going on in the markets for the administration, you look at those comments, is really nothing to see here, right? The U.S., they say, is shielded from some of this pain going on, or they think their economic agenda will help them shield it. And Jonathan, when it comes to these two individuals, there's lots of rumors that have gone around, specifically for Secretary Yellen. She was asked one of the first times in December 2021, not even a full year into the administration, if she plans on sticking around. So this rumor comes around a lot, and especially it comes around a lot when it comes to midterm elections, right? Will the president look to make some reshuffling after a midterm election? Right now, what we've heard from these individuals, from the Treasury Secretary's spokesperson, as well from Brian Deese himself yesterday, is that they plan on staying there. Brian Deese's quote was that he's really in the thick of it all and wants to absorb everything the administration is doing right now.
Your thoughts on what's happening in the housing market with mortgages and mortgage rates approaching 7%, in some cases going through it? AMH, how are they responding to some of this? Are they still comfortable with what's going on around them? Do they still just say the Fed's got space to do the job they need to do to bring inflation down?
I mean, they point the finger to the Fed. More of Secretary Yellen's comments when she was speaking to reporters in North Carolina was the fact that she said that around the world, central banks are fighting high inflation, barring really China, and that they're doing it at their own time and pace. And that is why you are seeing what we are seeing right now in the financial markets. When you ask the administration about their concerns about the economy, and reporters did ask this to the press secretary on Monday, she talked about the fact that the president had talked to his economic counsel on Friday. And what they have told the president, it was that their vision and their strategy for the economy, which is long-term growth, investment, manufacturing jobs back in America, they believe is working at the moment. So when I say they're really saying nothing to see here, they're really pointing the picture to what they think is working for the United States and saying at least we're not dealing with it as bad as, say, Europe or the United Kingdom, which is what Deese also said yesterday evening.
AMH, thank you. Anne-Marie down in D.C. Just on the housing market, mortgage rates this year in America have doubled. We had an index of 20 cities coming out in the last 24 hours, posting the first monthly decline since 2012. It's not just the US, we're seeing it in the UK as well for different reasons, that mortgage deals are getting pulled left, right and centre. Michael Purvis, Mona Mahajan joined us right now. Mona, what about this is desirable in the Fed's eyes, and what about it is undesirable as we start to see the brakes get hit a little bit harder in this economy?
Yeah, absolutely. Look, on the desirable side, to your point, I think what they're really seeing is the slowdown in housing and potentially the slowdown in the labor market that they've pointed to will ultimately lead to a slowdown in CPI, and especially that core CPI we talked about earlier. We know shelter and rent components of CPI, which make up about a third of the basket, tend to operate with a lag impact. But in a 6 to 12 month period, we should start to see this disruption in housing start to flow through. Now, on the downside, of course, one of the more structural components of the market that we will be watching is the housing market. If we think about where we could see really breaks in the economy and where we could see notable disruptions, I think housing is one of them. Of course, the other part of the story that they'll be watching closely, their move to a 4.5% terminal rate has really created, perhaps more so than ever, this base case among investors and markets really reflecting a recession rather than the discussion around whether we could reach a soft landing. So I think generally speaking, what now markets and investors will be thinking about is when will this recession occur, and really how deep or how long can we expect it to last? Now, in our view, I think we still don't see yet the scope for a deep or prolonged recession, but the exogenous shocks that we're starting to see in global markets, harder to handicap if or when they may arrive on domestic shores. But for now, I think the base case remains for a average, shallow, modest recessionary environment, probably sometime in early 2023.
Michael, are you comfortable with that assessment? The Fed has hiked 300 basis points in 6 months. In the last cycle, it took 3 years to do 225. Given the lags in policy, the tightening that's already in the pipeline, isn't a recession of some degree just already baked in? And does it have to be a short and shallow one?
I think it's hard to have high conviction on severe versus mild recession right now because there's a lot of good arguments you could make reading into the future, just extrapolating some of the impacts here of this policy, the lag effects on these policies. Of course, we're going to have some real economic problems next year. On the other hand, when you look at the economic bear case that's been articulated over the last 9-12 months, you still see ISMs in the mid-50s, right? You still see employment data very robust too. It's a very, very strange cycle. So it's kind of really hard. I know it's a cop-out answer there, but frankly, it's a sort of hard case to really handicap. And there's a lot of, for all the bad things that are likely to come, there will be, and there are a lot of them. There might be a lot of upside surprises there too. There's a lot of ex-U.S. sort of recessionary conditions that are coming into play. What happens if China starts stimulating after November's Congress and so forth? What happens if things are, we get a decent GDP picture with some ebbing inflation? We've certainly had some horrible inflation prints there, but if that reverses and the ISMs hold up and the participation rate in the employment data starts improving, maybe you really do have a good condition there. So I think but that's a lot of uncertainty there, and I think that uncertainty is going to keep risk appetite at bay here. And I think there's so many people who are going to keep parking themselves in those one-year Treasury bills or pretty secure investment grade paper, and just sort of let me just camp out in short-term yields.
That's what we're seeing.
Yeah.
Everyone seems to be doing the same thing right now.
Yeah.
Seeing it at the front end of the yield curve today, we're down 13 basis points on a 2-year. Michael Purvis and Mona Mahajan, thank you to you both. The former Fed president of New York, Bill Dudley, caught up with us yesterday after writing a Bloomberg opinion column. This is what he had to say about the Fed and Fed pain and the potential that this Fed is underplaying the economic pain from the Fed effort. What will happen when people realize that the job will be harder, the pain greater than the Fed has indicated? Support for its policies will probably decline and it will probably lose credibility. Bill Dudley went on to say something crucial to retain to get inflation under control. Something to consider. Coming up, the morning calls, and later, demand woes, keeping Apple shares lower. We'll speak to Dan Ives of Wedbush at the opening bell. 4 minutes and about 15 seconds away from the opening bell. Equity futures recovering positive 0.4% on the S&P. That's the price action. Here are your morning calls. First up, Wells Fargo downgrading Lockheed Martin to underweight, seeing a challenging year ahead due to weaker defense spending. Atlantic Equities upgrading Netflix to overweight, expecting its new advertising service to fuel a leg higher in shares. And finally, Morgan Stanley reiterating its overweight rating and 180 price target on Apple, saying the production headlines are more bark than bite. That stock's down by 2.6%. We'll talk about that with Wedbush's Dan Ives, expecting Apple shares to remain in the penalty box until October's earnings report. The opening bell just around the corner. Equity futures just about positive. Yields coming in from New York. This is Bloomberg. Coming into Wednesday, 6 days of losses on the S&P 500. 6 days of losses and going back to lows we have not seen since November 2020. It's been a while. Equity futures right now positive 1/3% on the S&P. On the Nasdaq 100, just about unchanged. Bouncing back from where we were this morning with yields breaching 4% briefly. There's the opening bell. Switch at the board and get to the bond market. It's a turnaround engineered by the Bank of England, not the Federal Reserve. The 10-year down by 13 basis points, 381 on a US 10-year. What a range already this morning after going through 4%. Briefly, over in the UK, gilt yields absolutely crashing. In some cases, down by about 100 basis points. In the FX market, dollar still showing some strength. Euro dollar 95.86, negative 0.1%. Pound sterling negative 0.7% at 106.56, and crude up by more than 1%, 79.43, just short of 80. Let's get you some movers around the opening bell about 30 seconds in. Here's Abby.
Well, John, we are looking at the first up day in 7, the snapping that longest losing streak going back to February of 2020. And the gain would be bigger for the S&P 500 if it weren't for Apple, down 2.5%. This, of course, as the company has said, that the demand is weaker for its new iPhone, so it has told suppliers to cut production by as many as 6 million units for the second half of this year. They thought that iPhone 14 would really spur a surge in demand. That has not happened, although one positive is there's more demand for that Pro Plus rather than the low end. Now, Skyworks and other Apple suppliers falling on this, not surprisingly. To the upside, though, Biogen right now popping more than 40%, heading to its best day for quite some time. This, of course, as its Alzheimer's drug, a breakthrough trial, sets the company up with its partner for FDA approval. Lots of Wall Street banks have upgraded, and it's the best day going back to, you were just speaking of November of 2020, since November of 2020. And then finally, oil. We do have Chevron higher, with oil going higher as well for a second day in a row, up 0.7%, John.
Abby, thank you. Let's turn back to Apple, down about 2.5% in early trading. Ed dropping by to get us up to speed. Ed, what's going on?
Yeah, it's a cautionary tale in resetting expectations at the last minute. As Abby said, sources had told us Apple went to its suppliers ahead of the iPhone 14 release in anticipation of elevated demand and said, let's go from 90 million units this year, 2022, which mirrored 90 million units in 2021, and boost it by 6. Now they're walking that back to the original 90 million, and you can see the market reaction. Apple at a July low, down 2.5%. Interesting, though, John, by the way, see the NASDAQ in positive territory, despite that drag from Apple, given its weighting. As Abby said, some suppliers had pivoted to adjust their production, at least one source tells us, to accommodate for that demand for the higher-end iPhone 14 Pro models. What are they going to do if that does not sustain? You see the reaction, key suppliers dropping. Qualcomm, for example, lower in early trading. Around a quarter of Qualcomm's revenue comes from Apple. It's a key maker of the modem that goes into those phones. So we're feeling repercussions around the world. Why do we care? Because we look to the smartphone market to get some kind of read on the strength of the consumer, particularly in China, where Apple drives 20% of revenue. Either way, we're kind of back to square one, 90 million units this year.
Ed, thank you, buddy. As always, in the penalty box. That's what Dan Ives of Wedbush has to say. Here's the quote from him. The overall iPhone 14 demand story for Apple is steady, but clearly not the home run success out of the gates, as consumers are not paying up for the base model in a softer macro environment. I'm pleased to say that Dan joins us right now. Dan, last time we spoke, and it wasn't too long ago, you said so far demand and orders for iPhone 14 are tracking slightly behind iPhone 13 and are tracking ahead of our expectations out of the gates. Dan, what didn't you see? What went wrong?
Well, I think you really have to separate, as Ed talked about, between iPhone 14 Pro and the base model. Pro continues to track 8 to 10% ahead of iPhone 13. Based on everything we've seen, I think you'll start to see production around that starts to ramp. In terms of the base model, I mean, that's been underwhelming. I mean, that's really the 6 million units, and that's obviously going to be a jolt to the street. But I still believe overall, when you put it all together, the overall demand story with iPhone Pro, that's the key, is better than the street's expecting.
Dan, based on how we're readjusting today and going into earnings in the next month or so, are you expecting then potentially weakness on revenue, but some upside on earnings given a better average selling price?
Yeah, I think the ASPs are so strong on Pro. I mean, the mix shift we think is 85, 90%. So I think that will be enough that we still believe, take out FX a beat in terms of the quarter. In terms of going forward, look, 90 million units, that was the line in the sand. I think the worry that they were actually going to cut 3, 4, 5 million off the 90 million units. And I think as this continues, specifically Pro, if it goes into holiday season, I believe they will start to increase production again, specifically on the Pro.
Dan, when was the last time this company had a real cyclical test for this iPhone? And I don't think the pandemic counts given the fiscal transfers. When's the last real cyclical test this company's had for the iPhone business that we can look back on and see how it performed?
Yeah, you'd have to go to 2016, 2017 in terms of, and there were specific product issues that they were dealing with. But if you go back since the 2007 launch of iPhone, right, just given the ultimate install base now, it's about 1 billion iPhones, they've been able to withstand economic pressures because of that install base, because of the upgrade cycle. And this clearly for Cook and Cupertino, it's a huge test to see if they can navigate the storm with basically unprecedented things that we haven't seen in some cases since 2009.
Dan, final question. We talked about this last time we spoke. I think it was my final question then. How would you know if you're wrong?
Yeah, the main way we know we're wrong is if we start to see wait times significantly come down for the Pro. We see specifically in China, any sort of weakness going into to call it December. If that happens, then the story changes. But for right now, we're not folding on our bullish thesis. It continues to be on pro, but clearly Apple underestimated on the base model. That's been very disappointing.
Dan Ives of Wedbush. Dan, thank you. The stock is down a little bit this morning. The S&P 500, the gains since the onset of the pandemic, trailing inflation in the United States. Let's bring in Taylor Riggs for more. Hey, Taylor.
And John, you're looking at it sort of an unchanged S&P 500. So if you get losses today on the S&P 500 and close at that, you're looking at 7 straight days of losses. That is the longest losing streak on the S&P 500 since February of 2020. And the losses haven't been insignificant. In some days, you're really looking at maybe 0.5 or even 1% decline. So getting that a little bit under pressure today. The interesting story is also within the bond market. John, overnight, of course, you had a 10-year that touched 4%. Of course, now we migrate back downwards to about a 3.83. But the point here has been a 10-year yield that actually is relatively attractive. I'm going from Tina to Tara. There is a reasonable alternative relative to that dividend yield, right? When you think about the opportunity that closing in on 4% on a 10-year yield actually represents in this market. Finally, take a look at sort of the next board when we think about full capitulation. Gina Martin Adams is saying that instead of maybe half of the indicators looking at full capitulation of what we had in June, a lot of maybe now 75% of those indicators, including the VIX, are pointing us more towards a bottom. When you think about an accumulation of finding a bottom in this market, a VIX that hovers above 30, around 33, is one of those signals that she's looking at.
Taylor, great work. Thank you. Just unreal. Just to see the S&P 500, not today, but yesterday at the close, back to lows we haven't seen since November 2020, and getting close to wiping out all of the post-vaccine gains from the pandemic. Unreal. The S&P down another 1/10%. The Nasdaq down by 0.4%. John Hancock's Matt Miskin expecting a recession to drive the Fed's pivot, writes the following. The central banks are the ones breaking things across markets and economies. We see a recession starting in a couple of months and lasting into 23. The Fed funds rate could even go back to 0% lower bound because the Fed will need to do all the heavy lifting to get us out of the next recession. Matt Miskin joins us right now. Matt, let's go there. Back to zero. Really, how quickly?
I mean, what's going on in the bank with the Bank of England and what's going on with the UK right now is a great example that fiscal policy cannot be the lever to get a counter-cyclical measure to get economies out of recessions. If you're doing all this fiscal spending right now, the cost of capital has gone up so much that the interest burden for these countries are going to be so significant that the Federal Reserve or the central bank is going to have to be the counter-cyclical measure. And I think if we're not going to get all the fiscal stimulus we've gotten out of these last recessions, then the Fed's got to get us out. You break it, you own it. And the Fed is breaking things right now. Well, they got to own it. And that means they're going to have to be cutting aggressively once we get into this recession.
Where would inflation be in that recession, Matt? And why are you convinced they're still going to cut?
So inflation, in our view, is coming down because you look at, copper prices, lumber prices, oil prices. Then you look at the housing market. Housing market, it takes forever, it feels like, for that data to show up in the consumer price index because of the way that it's calculated. But nonetheless, month over month, housing prices are likely coming down significantly. And look, it's a risk, inflation right now, I get it. But at the same time, the Fed has already injected a lot of tightening into the system. Monetary policy works with a lag. We're not even going to feel all this until the beginning of next year, into next year. That should really dampen demand, which unfortunately will dampen, or fortunately, will dampen inflation, but it's tough to just decrease demand like this.
So, Matt, let's just say you're right. And I'm sure there's some people shouting at the screen. They're always up saying you're wrong. But let's say you're right. How tradable is this call? How tradable is it?
John, I mean, Taylor had, you get the CFA charter holder here, and you're now coming up with new acronyms about, Tina's gone, and now we got Tara. I mean, this is what this market's all about, right? But, there is alternatives. There is. And if we can get 5-6% yields almost on investment grade bonds, and then potentially see price appreciation going into next year. And look, it's tough right now. I get it. But we're seeing the tipping point where central banks are tapping out, saying, look, we can't have yields go up this fast. And when that starts to unravel, when that starts to turn, and we think the Fed is going to have to follow suit eventually, because if the dollar goes up like this forever, or for an extended period of time, it's going to make it very hard for us to be competitive. And, at the end of the day, that's going to result in the Fed cutting eventually next year. We think that's going to result in price gains and income, which is going to be really competitive return from bonds into next year.
Matt Miskin, just finally, you understand better than I that there's a big difference between a pause, a pivot, and cutting all the way back down to the zero lower bound. Why is the call that aggressive, Matt?
Well, it's a sequence, right? So right now, the Fed is saying that they're not going to next year they're not cutting, right? I mean, Cash Card came out saying that yesterday, and it's just like the timing of these things. Last year, and we've talked about this before, John. Last year, they were saying they were going to barely raise rates, that inflation wasn't a problem. Now they're saying they're not going to be cutting rates. You follow the sequence. Next year, they're going to be cutting. And, at the end of the day, right now, we're saying short-term duration, intermediate duration, and then into next year when they start cutting longer duration. And that is actionable, and you get paid to wait. We get paid, again, on investment-grade bonds now, it's about 5%. We think that's going to be very compelling income while you wait for that price return coming out of the bond market into next year.
In 6 months, can I replay this clip to you? Are you happy me doing that? In 6 months from
Absolutely,
today.
John.
This is the timestamp. All right, Matt Miskin.
All right.
Thank you, sir. Appreciate it. Coming up, a busy week of Fed Speak continues with Chair Powell on deck.
We have to balance that off with our dual mandate with full employment and trying to navigate that to bring inflation down while we do so as gently as possible is a struggle.
We'll get the views of Mohammed Al-Arian very shortly from New York, with your equity market just about holding on and your bond market yields lower by 12 basis points on a 10-year after seeing 4%. Already this morning, we're back down to 383. Just wild stuff from New York. This is Bloomberg.
This is Bloomberg's The Open. I'm Lisa Mateo, live in the principal room. Coming up, Patrick Pouyan, Total Energy CEO. That conversation at 4:30 p.m. Eastern, 9:30 p.m. in London. This is Bloomberg.
We have to balance that off with our dual mandate with full employment and trying to navigate that to bring inflation down while we do so as gently as possible, not to tip unnecessarily the economy into a downturn that actually influences the full employment part of our mandate is a struggle.
That was Mary Daly of the San Francisco Federal Reserve. The Federal Reserve contributing to problems worldwide. The Bank of Japan has to respond. The Bank of England responding to problems elsewhere as well. Gilt, a 30-year UK government bond, is down 100 basis points in today's session. On the 30-year, the yield is now 3.91. That is a phenomenal move. Mohammed Al-Arian in the Financial Times a little bit earlier this morning writing the following. What is at stake here goes well beyond a disorderly tightening of financial conditions and a significantly higher risk of market accidents. Real damage is being done. Mohammed of Queen's College, Cambridge, I'm pleased to say, joins us right now. Mohammed, we're lucky to catch up with you. Can we start there? What damage is being done?
It's a whole series of damage, John, and thank you for having me. Look, there is damage being done to the average household and the average business as they deal with a negative income effect, a negative wealth effect, closure of lending markets, and inflation. Let's not forget that they're dealing with a cost of living crisis. Then there's a broader issue, which is a loss of credibility in policymaking, which means that policymakers will have to go beyond where they would normally would have had to go, as the Fed is doing in the US. And then finally, there is the longer-term standing of a G7 economy that is behaving like a developing country, including getting a reprimand from the IMF. I know you don't like that reprimand, but the fact that it happened is indicative.
Yeah, I didn't like the IMF reprimand because I think there's a bigger reprimand to be had down in Washington, D.C. that they seemingly want to avoid, Mohammed, but we can save that conversation for another day. We're both on the same page, though, when it comes to intervention. Mohammed, intervention is often unsustainable and it doesn't address the underlying issues. Within your piece today and within much of your work through the last week, you've made the point that we still have some underlying policy issues to address. Can you walk us through one by one what you think needs to happen here imminently in the next few days, the next few weeks?
Yeah, and let's take the example of the UK because I think it's very illustrative. So, John, we knew that the exit from the paradigm of easy money was going to be hard. And we thought that the major challenge was going to be the balance between inflation and recession risk, as you heard in the tape. The question now is financial stability. That it turns out that there's also significant financial stability risk. And all it takes is some action, some unforeseen action. In the case of the UK, it was the fiscal action to trigger this financial stability concern. So suddenly, the Bank of England finds itself in the ECB situation, where it has to figure out how to use monetary policy to contain inflation, and then some other measure to contain financial risk. And then these two things are in conflict. So we've discovered that this is an even more complicated exit, and it doesn't help that central banks are late. So I just think we have to buckle our seatbelt even tighter, and we have to recognize that policymakers are no longer repressors of volatility, but they contribute to volatility, and that this journey is going to be incredibly bumpy. And hopefully the new destination is a better one because it's less distorted, but it's a very bumpy journey.
Mohammed, before we even find that equilibrium without the distortions and without the central bank intervention, many people will say, given what we've done over the last 10 years, this proves it's unachievable. We've got central banks back in the game. We can't get away from this. What would you say back?
I would say this is different. This is not QE2 or QE3. This is QE1. This is an intervention that's aimed at financial stability. It is not an intervention aimed at promoting economic outcome. They can no longer do that. Inflation does not allow them to do a QE2 or QE3. That's why they put the word temporary. Now, I said to someone, how do you feel if I tell you that this is, I'm going to come in and help you and there'll be no limits, but it's temporary? And he said, I wouldn't feel very well. And that's the dilemma they're in, that they cannot have these open-ended QEs anymore. So this is different, John. And I think that the optimism of the US markets that this implies a significantly less hawkish Fed is interesting, because if it means a less hawkish Fed, it would mean because we have a financial stability problem. And that's not something we want. But that's how the markets immediately translated the intervention by the Bank of England.
Mohammed, I hear the same thing from you that I've been thinking now for the last couple of days. When I hear the Fed pivot, the Fed pause, if these central banks are going to have to pause or pivot, it's going to be for some pretty bad reasons, Mohammed. And that's not necessarily going to be a constructive thing. That's not going to be a reason to buy this equity market. Is that what you're trying to convey?
Yes, John. They're going to pivot for one of two reasons, if they pivot. One is because recession risk has become unacceptably high. Two is because we are very close to a financial accident. Neither of these things are good for risk assets. So again, if you are voting and expecting a pivot, you've got to be clear why it is they're going to pivot. They are not going to pivot because the indicators they're looking at are coming down really quickly, inflation, etc. That's going to take time. So they will pivot either for a bad economic reason or for a bad financial stability reason.
Forgive me for putting you in an uncomfortable position before I even do so, Mohammed. Just a question on the Bank of England. Next scheduled meeting is November 3rd. Two-part question, really short because I've only got 30 seconds, but I want to squeeze it in. Can they A, wait that long? And B, if they can't, how big do you think this hike needs to be?
So I was on record saying they should have done a 100 basis point emergency hike on Monday. They need to do it. They're not going to be able to wait till November 3rd. It is a very long time. And you're talking about minimum 100 basis points, and 150 basis points is not off the table.
Hey, Mohammed, looking forward to catching up. I think we're going to do that again later this week. There's going to be a lot to talk about. This market has been absolutely wild. Mohammed Al-Arian there of Queen's College, Cambridge. Good friend of ours, good friend of mine, good friend of this programme. Coming up, the Trading Diary is up next. Well, What a messy morning. I've got absolutely no idea where this market closes this afternoon. No idea at all. We're positive for now by 0.25% on the S&P 500. That's the price action trying to snap the losing streak of the last 6 days. Here's the trading diary. President Biden at the top of the hour, followed by Chair Powell kicking off a host of Fed speak throughout the day. Bullard, Barkin, Evans all on deck. And it's Brainerd, Bullard, Mester and Daly on Thursday. Plus, we get US GDP and initial jobless claims. And on Friday, rounding out the week with personal income and spending and the University of Michigan Consumer Sentiment Survey. Guy and Alex will pick things up in just a moment from me. Thank you for choosing Bloomberg TV. This was the countdown to the open. This is Bloomberg.
From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It is 30 minutes into the U.S. trading day, Wednesday, September 28th. Here are the top market stories that we are following for you at this hour. It's the BOE's whatever it takes. The Bank of England pledges unlimited bond buying to save the gilt market from crash and prop up pension funds. Yields on the long end soar 100 basis points. The pound, though, goes nowhere. And no Plaza Accord. Brian Deese, National Economic Council Director, throws cold water on the idea of a coordinated attempt to crimp the dollar's rally. The currency hits another record, causing havoc in the market. And Florida braces for Ian's impact. Hurricane Ian nearing a Category 5 strength, on track to hit Florida, potentially causing as much as $45 billion in damages. From New York, I'm Alex Steele with my co-host in London, Guy Johnson. Welcome to Bloomberg Markets. Guy, it's really hard to know where to start today. 100 basis point move, that's not supposed to happen on the long end of any kind of bond.
Yeah, this is meant to be a risk-free asset. It's not behaving like a risk-free asset. I don't know, things are moving pretty quickly. Over the last 24 hours, you've had all kinds of events which, in isolation, could upend markets. You've got potential sabotage on a major gas pipeline. You've got what is happening in the UK gilt market. You've got the currency moves and the associated moves all the way around that. There's just, the stories go on and on. I thought the story would be Apple this morning when I woke up. That was the first story I read this morning.
That feels super old now.
So, yeah, it's... Precisely. There's a lot going on right now, and all of it, I think you can bring it all back together, but you've definitely got to spend a bit of time trying to join the dots at the moment, but I think it's worth doing.
Yeah, just to point out also, Guy, the EU is proposing a new package of Russian sanctions. You have EU Commissioner President Ursula von der Leyen is commenting right now. We're going to bring you those headlines as they continue to cross. This comes, of course, as leaks on 3 different pipelines, and also questions over Naftogaz and Gazprom, basically essentially looking at zero gas now going during the winter from Russia to Europe. And we also wind up having more economic data here in the U.S., just kind of reinforces the trend of where we're going.
Absolutely. Pending home sales, let's deal with the details of what we've got here. You've got a negative number, -2. That's down from -1. 1% I'm talking about here. Slightly worse than anticipated, but not significantly worse. We're going to talk to Zillow a little bit later on to get a take on what is happening in the U.S. housing market. But it is a consistent theme, I think. These are assets that have been buoyed significantly over the last year or so. We are now seeing significantly higher rates, Alex. All of that is coming together to send house prices lower. But what normally happens is you get a period of indigestion. Basically, you get a period where the market doesn't move very much. Then you see kind of the price resetting. And I think we may be just entering that period where basically everything kind of drifts sideways. Nobody's really willing to admit that they're prepared to accept the new prices. We're definitely not there yet.
No, we're not there yet. More headlines here, Guy. Sanctions from EU to Russia will hit individuals as well as trade. Von der Leyen saying they won't accept any Russia annexation in Ukraine, and the goal is to deprive Russia of about 7 billion euros of extra revenue. So, like I said, we're going to keep our headlines on that as well. And that's just the geopolitics of the whole thing. And then we have sort of the market reaction at the same time.
Absolutely. We'll get Maria on a little bit later on, Maria Tadeo, to work our way through that package that had just been announced out of Brussels. So the big question, Alex, now is the dollar now at the point where it's starting to significantly break things? And I think maybe the evidence out of the UK does suggest that we may be getting to that point. So what we're trying to figure out at the moment is, are we getting to the point where we need to see coordinated action. There's been a lot of talk over the last 24 hours about a Plaza Accord. White House National Economic Council Director Brian Deese talking to David Rubenstein, saying that he doesn't expect that we're going to see a repeat of that 1985 style of agreement amongst major economies, which was basically designed to counter dollar strength.
Do you see any possibility of a global accord to kind of adjust currency values the way there was with the Plaza Accord, or is that just not something you're focused on?
I don't anticipate that's where we're headed.
You're never going to say it before we get there, are you? You're never going to say that that's the direction of travel, because then we're already there almost. So the question of the day is a fairly straightforward one today from Alex and me. Plaza Accord 2.0, is that where we're going? Macro strategist Vincent Signorella was there trading the last one. Vincent Signorella, probably a good guy to talk to today, as is Bloomberg's Eddie van der Volt. Vince, let me start with you. If we're not there yet, are we getting close to the point where the dollar strength does require some sort of coordinated action?
I think, regardless of what Mr. D says, yes, we're getting there. I think it's going to take a rush on sterling, perhaps towards parity. I honestly would not be surprised if that happened. The UK government is definitely setting the currency up for a bad run. Not that it hasn't had one already, but I mean a crisis kind of run where you sort of get that almost 1992 moment where we see a major sell-off in the pound and we tackle 100. I think that would bring out the conversation among Treasury departments that the dollar has gone far enough. We've already seen big lows for the euro. We see it in cable. I think some sort of coordinated intervention would be necessary to stem this rush. And you know, the dollar at these levels doesn't actually help the Fed situation at all either. So it would be beneficial all around.
And it doesn't help any other central bank either. I mean, the massive moves that we saw from the BOE and the gilt market, like not at all reflected in the currency market. Eddie, it's hard to really tell how much is a dollar story and then how much of it is like dysfunction in other markets. Eddie, just walk me through these kind of moves that you're looking at and your team's looking at.
Absolutely. I think, you know, it just adds to that sense of crisis in markets, right? We sort of felt like it started to look as if things were calming down. But when you see the long end of the gilt curve just move that much and it feels crisis time, then, you know, central banks do have to step in. And I agree with Vince. And I think, you know, this is one of the fun things about having Vince on the team with us, because he's not only, you know, been there and seen it, he was there and trading it. But I think, you know, what we're seeing this time around is whether we get a coordinated effort or whether we're seeing the central banks one by one going it alone, I think action is going to be required for a lot of the central banks. And I think, you know, I think a lot of them will just have to be a lot more aggressive on raising rates. I think whether the question is how they address it, not whether they're addressing it. Yeah. I think they are going to have to address it. But the question is whether they're going to address it purely through monetary policy or whether they're going to have to step into the market.
Can they keep doing that? Today wasn't about monetary policy from the Bank of England. Today was about financial stability. Are we pivoting from a focus on monetary policy to central banks worrying about financial stability? Ultimately, that's what they need to preserve at this point. If you want to have a functioning market, you have to preserve financial stability. The Bank of England had a major crisis in the pension industry. It needed to deal with it. Are we going to see other central banks having to pivot to that, away from the rate hiking that you're talking about?
I think you nailed it on the head there. I think, you know, when you see your pension industry starting to struggle, when you see these kind of moves on the long end of the gilt curve, that really spooks central bankers because it signals instability in financially important institutions that's going to affect everybody, you know, all of their consumers. So I think this is something that worries people. But I think, you know, I think the fact that central banks in Europe and UK and elsewhere have not been aggressive enough in raising rates in the first instance is why they are struggling with these problems. We've seen with the yen, for instance, they were behind the curve on hiking rates. We saw with the Bank of England, they hiked less than the Fed at the last meeting. And those are the places that now have to take additional steps. So I do think it's the failure of monetary policy that is forcing their hand into being more aggressive on other fronts.
So, Vince, I hear what you're saying, that if we get to, say, parity on the cable rate, that's going to prompt the calls between the Treasury heads, et cetera. But Janet Yellen just yesterday said, look, the market is functioning properly. That doesn't sound like someone who's worried about dysfunctioning markets. And the UK, in that respect, seems quite idiosyncratic.
Well, I would point out the fact that Ms. Yellen also thought it was transitory inflation. I think we potentially could see a similar problem here in the U.S. with the pension situation, with equities down this low, and we're probably going to see some ugly earnings coming out, given where the dollar is in the FX space, which reduces earnings per share in large corporations. We saw it particularly with Microsoft in the last round of earnings calls. The central banks, I'm not so sure realistically who's been more irresponsible. The too much money put in during the pandemic from Treasury departments, or the laissez-faire attitude of central banks, and now being too aggressive in trying to raise rates to secure their credibility. I mean, it's really just a credibility issue. They blew it with the transient policy. Now they're trying to get their credibility back by raising rates aggressively. I think egos aside, we need to have central bankers and treasurers sit down and look at the markets and look at what's going on and deal with this in a rational way. We've put too much money into the system. We've kept rates too low for too long, and now we're aggressively going the other way. What Truss's policy of cutting taxes,